Good afternoon and happy Thanksgiving, everyone. Hope you had a beautiful and blessed holiday. This is Rich Delgado with DLP Capital, joining you here for a Left Field Investors webinar, a little educational debt versus equity investing webinar. So hopefully you'll find this informative, fruitful. And again, if you have any questions after viewing this, feel free to reach out to me or any member on my team, and we'll be happy to go through it. First and foremost is our what we like to call Chief Legal Officer disclaimer, which is just stating that we are not advisors. We offer investment funds, but we urge you to consult with your accountant, consult with your attorney, and ensure that you're getting your own level of due diligence done. But hope you enjoy this presentation. Again, Rich Delgado, DLP Capital. I'm a managing director of structured finance and capital partners with DLP. I started with the company in April of 2019 after about 30 years in structured finance, primarily with two public companies that I spent most of my time with. Helped both of those companies grow to be over $600 billion in mortgage servicing rights. That was, again, a great career, managing both debt and equity, all the securitization work, as well as all the financing facilities. I had $7 billion of financing facilities across 14 different lenders, worked directly on the investor relations side with all the equity analysts being public companies. And I did start my early career, and I don't usually confess to it, but I was CPA early on in my career in New York for Deloitte & Touche. But it's not about me. This is about DLP, and our founder at DLP is Don Wenner. He is the CEO, has started the company almost 18 years now, back in 2006 after graduating from Drexel, has helped grow the company over 50% for every year, pretty much throughout all of those years, and has done an outstanding job in helping us achieve great growth at the company, but not just growth, profitable growth. And he wrote a book called Building an Elite Organization, which again is about how to build a high growth, high profit business. And again, just recently, he followed that up with a new book called Building an Elite Career. So again, that is available, and we're happy to send it to you if you haven't already purchased a copy. Don is considered one of the top 10 real estate professionals in the United States. He's done over 10 billion of real estate transactions and funded now close to 5 billion in loans, which again, we're going to talk about the difference between the real estate and the loan side when we talk about debt and equity. So who we are, so we are a private financial services and fully integrated real estate firm focused on impact solutions, targeting the nation's largest crises through lending and investment products, services, education, and systems. And that's important because everything we do is about impact. We are impact investors. We try to do not just do well for our investors, but try to do good in the community while doing well for our investors. This is our great leadership team. Again, you have a lot of breadth of experience here. You can see again, Bob Peterson is our Chief Financial Officer, has had extensive experience in real estate for well over 40 years. Jim Boyce, over 30 years as president and development and construction, has had previous careers in development and construction. And again, I won't go through everyone on the team, but we just hired Teresa DeBose, who joined us and has extensive experience in portfolio and asset management. Our Chief Lending Officer, Tom Halleck, who has spent time at Genesis Capital and other great firms before that. Similarly, Mike Duran from Greystone and Lou Davis, both directors of investment. And again, Lou is on his second tour with DLP, returning to join us back and the investments team. And then Nick Lanny, who runs our risk and investments, both on the lending side and the equity side, and has been with DLP for over 5 years now. One of the things that's an interesting fact, and urge you to take a picture of that QR code, download the article. It's a great article. again, this is just a little something that'll tell you about the community that we've built at DLP, not just our overall investor base. Today, we serve over 2,600 families, but amongst those families, we have a bunch of physicians, and that's across every aspect of the medical field, including dentistry and anesthesiology. And again, we have emergency doctors, physicians, gynecologists, you name it. But they have now, through that community that we've worked with, and there are different communities like LFI called White Coat Investor, and these also Passive Income MD, and Physicians on Fire, and a bunch of different firms. We now have over 260 million invested through this community alone. So again, hope you enjoy that article. Our goal is really to improve, preserve, and create rental housing that is affordable for the working families and will continue to be affordable for working families, which is our effort to combat America's affordable housing crisis. Affordability is the worst it's been since 1984. You can see the statistics here. You all know where mortgage rates are. And again, while we do expect those to start leveling off and coming down potentially by the end of next year, beginning of 2025, you can see rates have really wreaked havoc. This is now the highest median household income percentage that it takes to make a mortgage payment on an average home. So the average payment is now up to $2,440, which is an increase from just 2 years ago, almost 100%. So again, what we do at DLP as we try to combat that affordable housing crisis is really build thriving communities. You're going to hear me talk about that a lot, and transform lives. That is really our mission. And we do that 3 different ways. We do it by developing and constructing new rental housing communities that are affordable for working families. That we do mainly through our Building Communities Funds, hence the name Building. We're building brand new workforce housing. We acquire existing workforce housing and manage it. And again, all workforce affordable housing, that's in our DLP Housing Fund. Think of a value add strategy. We go in and improve the properties, make them better residences for our folks to live in. And then we lend to top tier real estate operators and developers that do the exact same thing we do, which is to build and acquire housing that's affordable for workforce housing families. And we do have 2 credit funds that we'll talk about, the DLP Preferred Credit Fund and the DLP Lending Fund, both of us being debt funds versus the top 2, which are equity funds. Our investment thesis, right, is pretty simple. We are basis buyers, which means every property we buy has to have equity in it when we buy it, meaning if we sold it the next day, we turn a profit. And that's just been our rule of thumb and has served us well in continuing to meet and exceed our targeted returns for every period, for every fund ever. We really stick to the areas that we like, that are very attractive. That is the Southeast and the Sun Belt, going out as far as Texas and tier 2 and tier 3 markets, primarily because those are high growth states with increasing populations, increasing incomes, workforces, jobs growth. So again, we like to stick to those areas, and they've served us well. Again, we also stick with multifamily and single family. We're not, again, while we have done as a real estate operator, we have done different property types within our funds. We really focus on residential communities, workforce housing. And again, all really on the rental side, build to rent. We look for it to be affordable, hence why we're in tier 2 and tier 3 markets. And how we define that affordability is that the rent will be no more than 30% of the average area median income. So that's, again, the AMI, average area median income. And again, our average typically runs in the low to mid 20s. So again, keeping homes very affordable for our residences. And again, we try to build that community. We want folks not to just be there as a renter for 1 or even 2 years, right? We want them in there for 8, 10 years. We want them to build community, get to know their neighbors, enjoy time together, and really prosper. Again, from the heat map, you could see, again, the areas we talked about in the Southeast and the Sun Belt, going out to Texas. We do have some properties, as you'll notice up here, in the Lehigh Valley, Pennsylvania area, which is where DLP started. Don started the company in Bethlehem, Pennsylvania, and we do maintain that yellow dot is our office up in Allentown, Pennsylvania. So we do maintain an office there. We have offices in North Carolina and a few in Florida, in Orlando, and our headquarters, which is in St. Augustine, Florida. All right, so we'll get into the meat of it now, knowing a little bit about DLP and our background. What is the difference between debt and equity funds, you ask, right? I mean, this is what you're here to learn and talk a little bit about, right? So really, when we look at these different funds, and we offer both debt and equity funds, 2 of each, you really look at the differences between the two. And while the debt funds have lower risk, they also have lower return. And conversely, the equity funds give you the opportunity for outsized return for what I think is relatively not much more risk, but from an equity perspective, because of the order in which investors get paid, debt gets paid before equity, hence it has a higher risk profile and debt has a lower profile. Again, both of these are great for passive income in terms of being able to be involved in real estate, either through debt or equity, without having to personally be a landlord or a real estate operator yourself directly. Distributions, again, for the debt are really based on the interest that is collected on the loans that are made. So again, that is where the returns are coming from, where on the equity, you're really getting distributions coming from rental income, sales of properties, and any creation of value in the real estate itself. So it's often a little bit more volatile return, although DLP as a whole has been very consistent in terms of its overall return profile. And you'll see that when we look at the debt, right? I mean, again, there is a cap as to how much you can make, but it's been very consistent, over 10%, double-digit returns. Our return of capital, right? So again, in priority of payment, debt is senior to equity and gets paid first in any kind of a liquidation event. And then equity is junior to the debt holders. The debt you're going to often find is going to be a shorter term. So our loans are bridge loans to real estate operators. So short-term loans anywhere from 6 to 24 months, which really, on average will pay off in about 12 months. So again, when you talk about the short-term nature of that debt, it's a lot less volatile. So again, considered lower risk from a duration standpoint. And then the equity, we typically model acquisitions when we buy a property to be a 5-year hold. However, we might sell that property within 2, 3, even 4 years. We might even hold it for 7, 8 years, right? Depending on market conditions and really the strategy in the fund. But we have 62 properties in our housing fund, so we have a lot of opportunities to do different things with different homes. And then in the building communities fund, similarly, these are going to take, typically anywhere from 2 to 3 years to build and then lease up. And so again, you're talking about a longer term hold on the equity side, converse the debt side of it. And from a tax reporting standpoint, the debt is going to be a 1099, again, dividend income because of the interest nature of the payments, and you'll get a K1 on the equity side. And I will say it now, the one thing you'll find with DLP is we say what we do what we say, and we do get our K1s out on time. We have never been delinquent on getting those out. We've always reported on time. So one of the things you'll have to look forward to if you work with us on the equity side. And then what are debt funds? So debt funds are typically, as I mentioned, where we're lending capital to real estate operators and developers that are going out there doing the exact same thing. They're going out there buying properties or building from the ground up properties that they're going to build for workforce housing to rent out, to make available. And again, we're lending to them on a first lien basis, in most cases under our lending fund. And then it could be a second lien or mezzanine loan or even preferred equity if we're doing something in our preferred returns fund. So again, depending on where that fits. But typically, you're going to have some collateral, especially if you're in like the lending fund. It's going to be first lien. You're going to have the mortgage behind that. And then again, we get personal guarantees from the borrowers as well. So you have a lot of protections there. And the fund itself acts as the lender. So while DLP is doing the underwriting and the originator, the fund itself is the originator making those loans and making that capital available to the real estate operators. Investors themselves get paid through the regular distribution. So again, as interest is being collected on each of those loans, as loans are paying off, that return of capital is going not only to pay a return to our investors, but is also going to pay down any of the leverage that we might have in there. So we use a combination of debt and equity within the funds to make the loans. And so the capital that comes in from our investors is used to make loans, and then we're paying back. We don't use new investor money to go ahead and pay off other investors. It's done by return of capital. And then investors can either choose to take their distributions on a monthly basis, or they can reinvest them. And that is true across all of our funds. I'll also say that whether it's debt or equity, you can invest in any of our funds through a qualified account, whether it's an IRA, a 401k, SEP plan, a 403b. There's a lot of different qualified funds, and we have today well over 800 qualified accounts that we manage through different custodian platforms. Again, what is typical with debt funds is that if a borrower did default, we as the lender are secured and have a senior claim in our lending fund to that property. So again, senior again to the equity of the borrower itself. So again, this means that we get paid our money back first before the investor gets any of their money back. And again, the good news with DLP is that we are a real estate operator. So if we ever had to take back a property, we can do a lot of different things with respect to that property. We can finish the construction on the project. We can lease the property up through our property management and asset management group. We can sell the property through our realty team. So there's a lot of different things that we can do to help mitigate any risk on loans. And again, that's been a great success for us over the thousands and thousands of loans we've made. We've only had a few dozen ever default and have to take back and work through. Most of those we've gotten back, returning cash flow. But the good news is that as a lender, our funds have never experienced a loss. So investors have always gotten 100% of their principal and their interest in all of our funds, including our debt funds. So again, when you look at your typical pyramid, again, the risk reward from a potential risk and return profile, the equity investments, again, have a higher risk and are below the debt investments. And then again, what are some of the benefits of investing in a debt fund? So first and foremost, they're super liquid because of the fund that we have. The funds are short-term bridge loans that we're making to investors. Those funds then offer ultra liquidity, meaning you can get out of our funds with just 90 days notice at any time. So that's a big benefit to our investors with having ultra liquidity. So you can join the fund, invest today, and then tomorrow come back and say, hey, I'd like to take my money out. And with our funds, because there's so much liquidity and these are such short-term nature and funds are generating so much cash flow, we've never taken 90 days to pay back any of our investors. Again, you do have regular monthly distributions from the interest. That goes in turn, you can either take it and take those distributions, which is great for anyone looking for income. If you're at that stage in your life where you're just looking for supplemental passive income to support your lifestyle, support retirement, these funds generate great monthly income. Again, 10% plus, all the distributions are paid monthly. Or you can reinvest if you're younger and you're looking to just grow your portfolio and want to do it to have diversification in your portfolio. This is a great fixed income product to have in there mixed in with your overall allocations, and a way to grow and compound significantly over the life of the portfolio. And you're going to find out all of our funds are, again, evergreen funds, meaning they have no end date. There's no maturity date. These are all open-ended funds. So you could be in these funds for 10, 20 years and grow significantly within the funds. So again, continuing on, these are collateralized funds, right? You have future cash flows that mitigate any risk. There's senior positions, and again, payoff returns, all the capital to our investors. And then adding debt investments is a great way, as I mentioned, to diversify your portfolio and offset other risks from either equity or equity investments in real estate. Now, the downsides. So unfortunately, while it's a great product, it is going to be a lower overall return, or limiting the amount of upside you would have as compared to equity funds. So in equity funds, right, there's a potential to get high teens, low 20s, even higher returns. You just can't do that with debt funds, because you can only charge the borrower so much interest and create so much interest income. So again, the other side of it is that the investors are generally not entitled to any of that upside that comes from where the equity owner, right, the appreciation that you would get, the additional cash flow, that's what the equity owner is basically getting. And you can get that through our equity funds, just not in debt funds. So again, that's the downside. So how do you know if you're investing in debt? How do you know if investing in debt funds is right for you? There's certain things you'll want to consider, right, when you're looking at this. First of all, your overall allocation strategy, right? How do you mix in and prioritize lower risk over higher returns? Liquidity, right? Do you need more liquidity and be able to have access to the money on a shorter term basis, right? And are you seeking, potential for regular distributions and getting, again, regular income? So there's a lot of differences, and you can mix all these up. If you start investing in our funds and say you start taking the distributions on a monthly basis, you can always stop and start reinvesting, or vice versa. You can start reinvesting, and when you're ready to start taking supplemental income, you can make that switch as well. So again, we'll shift over now from the debt funds to the equity funds. So what are equity funds, right? So the equity funds are you investing on a passive basis in the direct investment of a real estate project. So again, we raise capital through our investment funds for investors to have exposure to real estate. The fund becomes a property, or I should say the property becomes shareholder property. So the property itself is owned by the fund, and all of our funds are set up as LLC. So while you're not a direct investor in the property itself, you're investing in the fund. That gives you lots of great protection, and I'm probably getting ahead of myself, but you're going to have geographic distribution, you're going to have diversification. It's going to give you a lot of benefits of investing in real estate, just like as if you owned the property, but with a lot more properties to diversify yourself through. And again, you get a share as an owner in that fund. As a shareholder in the fund, you get a portion of the profits that are distributed, that come off, the rents that are collected. Those are the cash flows that are used to help make the preferred payments, which we'll talk about on a monthly basis or quarterly basis, as well as to help pay any excess and get you your overall annual returns. Equity funds typically offer, again, the potential to earn, as I said, monthly or quarterly income in the form of, in this case, preferred distributions. The way our funds are set up is we pay a preferred return to investors before we earn a management fee. So again, you can collect a steady stream of income. You could either take that income or you could reinvest it. And then all the excess, we call it EDC, excess distributable cash, is paid at the end of the year. And that comes from any of the excess rents, any sales of the properties, and then any capital appreciation earned. And again, you get any kind of prorated amount of any gains, again, as I mentioned, from sales of properties. So the equity funds generally will offer you higher returns than debt funds. And that's, again, from that risk return profile. You know, you can create really outsized returns. I mean, our housing fund has had a pretty great run. It's been over 26% since inception. But again, that's not the expectation for every year. But again, there are years we had in 2021 a 45% return, for instance. There are going to be years you can do that when you have big sales from properties you're able to buy at pretty discounted prices. And then again, hold periods can vary from a few months to many years, and in general are going to be longer term than your debt funds. And so returns are typically going to be higher, but carry that additional risk that we talked about. So what are the pros in investing in equity funds? So the first we've talked about, right, is you're going to get higher return. You're going to get part of the profits. You're actually going to be entitled to some of that capital appreciation, your pro rata share. And then again, all the returns are determined from the profits of the rental and isn't limited, right? Whereas you're limited in your debt funds as to how much interest is actually collected and can be returned to you. There, you know, sales could be determined and can give you really outside returns. And then depending on the fund structure, you may also be entitled to tax benefits from depreciation. And we'll go through that comparison when we talk about our housing fund, which passes through depreciation to our equity investors and gives you great tax benefits versus our Building Communities Fund, which today is still developing a lot of properties. So we don't have a lot of depreciable assets, properties that are already structured. It will have some in the future, but it will never be as tax efficient as our housing fund, but both will offer some level of tax benefit. What are the cons in investing in equity funds, right? So again, your debt funds, we talked about having 90-day liquidity, being able to get out with just 90 days notice. The equity funds, and again, typically most equity funds have lockout periods and you can't get your money out of them, particularly if you're in a single asset syndication. You'll be locked out 3, 5, 7 years, depending on the maturity of that asset. Whereas in the funds we run, we offer annual liquidity for you to be able to get out in whole or in part every year. And that's simply because of the fact that they are open-ended funds, right? So you can be in these funds for 10, 20 years, and we'll talk about some of the benefits of being able to be in there without having to sell in risky market times, similar to what we're experiencing today, right? You can just ride out the markets and really just continue to collect rents. These are rent and income producing properties. So again, that's one of the benefits of our funds. But again, compared to our debt funds, you will only have annual liquidity versus being able to redeem at any point in 90 days on the debt funds. They also carry a little higher risk, right? In the form of volatility. We talked about market conditions today. So again, having that change in markets can cause fluctuations in the return, as well as again, you have the ability. You're senior in a debt structure. If there was ever a volatility, getting paid out. Equity investors are the last ones to get paid if a project fails versus the debt holders who get paid first. Now, thankfully, knock on wood, we've never had a loss to our investors in any fund ever. But some of the things you want to consider when thinking about investing in equity funds is first and foremost, again, how do you prioritize that return, right? Do you look for higher returns? Are you looking for growth? Are you later in your life and looking for more stable cash flow and lower risk? What can you financially accommodate, right, with a longer hold period in terms of how much can you put into these particular funds and into real estate? Are you looking at generating regular distributions or reinvesting those, right? Again, if you're seeking passive income and wanting to collect some level of income on a monthly basis, You can do that in all of the funds. You'll have less in terms of the amount that gets distributed in an equity fund on a monthly basis, but overall you still have liquidity coming through in all of them. You have a higher risk tolerance, and are you comfortable with the chance that you don't get a return or you have a potential loss? So again, we always ask you consult with your financial advisor, your accountants, your attorneys, your advisors. Just really get to know what your risk tolerance is to inform your overall risk strategy. So again, summarizing our debt versus equity funds, right, from a tax perspective, the debt funds will be 1099 divs versus your K1s and your equity funds. So again, our debt funds are DLP Preferred Credit Fund and DLP Lending Fund. Our equity funds are the DLP Building Communities Fund and DLP Housing Fund. Again, you will have the ability to use the depreciation in the equity funds that gets distributed to you. Unfortunately, the debt funds, right, it's a 1099. You do not have the same level of tax efficiency. You will not have depreciation since it's interest income, so you don't get any of that benefit. So again, just going through a couple of just things you should consider, right, when thinking about, hey, I want to invest in real estate and not necessarily debt. Do I invest in a fund or do I invest directly in a property or a syndication? So there are things you should really consider here as well, right? And the basics are, in a real estate fund, you do have more diversification, right? And again, you're investing into a number of different properties that a fund manager has done significant due diligence on, right? And versus just an individual property investing in. And again, single investment is a great way to invest, but you take a lot of that risk that if it goes bad, you're going to take losses. Whereas, if one of our properties went bad within, let's say, our housing fund or even our building communities fund, right, you have the other funds that do well that'll offset that. So offsets any of that risk. And again, makes it for a much more diversified, much more geographically dispersed portfolio. When you're in a single asset, right, you basically, especially if you're going to be the real estate operator, you have to manage it. You're the landlord. You're the one taking the calls to fix, the plumbing in the middle of the night. There's just so much more that can go wrong versus, investing through a fund where you get all the same benefits, but you don't have to do all that work. You can just do it passively. Next, again, when you look at DLP's funds, right, again, we talked about our lending fund is our most secured. It's all first lien assets. So again, that's going to give you, again, the lowest targeted return, which is still great, from 9 to 10%. You get a slightly higher targeted return, 10 to 11 in our DLP credit fund, which also has first liens, but second lien and mezzanine debt as well. And again, as you get into your, you might even have some preferred equity, but as you get into your housing fund, right now you're really looking at the targeted returns of 10 to 12%, which again, I've mentioned has been over 26% since inception. And then the building communities fund, which is the highest targeted return since you're again investing in longer term building of new construction and development of workforce housing communities. So the DLP lending fund, again, is all first lien mortgages, all very low loan to value, loan to cost. Our typical average loan to value is about 55%, and our loan to cost runs in the high 70s, 77 to 79, which is phenomenal to have over 20% equity in any project from the underlying borrower. So you have a lot of equity supporting these different loans. So again, significant equity that's subordinate to us in the fund. And by the way, I should mention, I've been an investor in all of our funds. I like the exposure, and I'll talk a little bit about how I invest in the funds and my strategy, if you want to consider it for what it's worth. But again, these are not loans to individuals to buy their primary residence to live in. These are all non-owner occupied loans to full-time real estate operators that are building or buying rental properties, right? These are properties that they're using to create rental income. And again, all short-term bridge loans, typically 6 to 24 months. In our preferred credit fund, we talked about it a little. It's not just first liens. These could be secured by equity pledges as well as personal guarantees. We can offer second lien, mezzanine positions that are subordinate to the equity holders. So again, looking side by side, we can share with you a nice funds comparison, these two, and then again with our equity funds, we could even show you, we have a beautiful funds comparison that puts all four side by side. But you'll see the preferred return, again, that gets paid 9% monthly preferred, 8% monthly preferred. Now, what that means is anything above that preferred return, we share 80-20 with you. We get 20% as a promote, you get 80%. So again, we don't even earn our management fee, again, until you get at least your preferred return. However, these are make monthly payments. All the distributions are paid monthly. So you get all of your return on a monthly basis in both funds. Both funds offer a rebate. So once you have over $1 million in the fund, you get a 50 basis point reduction in your management fee. And for over $10 million, you get a point reduction in the management fee. And again, 90 days notice. This is $1 billion fund in the preferred credit fund, $2 billion in the lending fund. And while our investment minimum is $200,000 for investors, for left field investors, we do offer it at $100,000 entry point. And we already talked about the 1099 DIVs. And again, I'm not going to go too much more into, again, the lending criteria. We already talked about a lot of it. Is really going to be in residential properties, again, single family, multifamily, manufactured housing, and RV camp park communities, whether it's existing or new construction. We look to, again, work with really strong operators that have a track record of completing acquisitions, development, and exiting properties on a regular basis. And again, most of the folks we lend to are repeat borrowers. So again, over 90% of the borrowers that we lend to are repeat borrowers. And then again, where we invest, we've talked about in the Southeast, the Sun Belt, really looking for high growth areas. And again, doing it through a managed balance risk approach. Shifting to our equity funds, the DLP Housing Fund is a real estate fund where we acquire existing real estate. Think of a value add strategy. We're going in there and improving the properties, creating better communities, better residences for the tenants that are living there, helping them really enrich their lives, adding amenities to them. And then again, this also allows us in this particular housing fund that we can invest in a preferred position with common equity subordinate to the fund. So we can do direct equity investments or preferred equity investments. Our Building Communities Fund, again, as the name mentions, is building from the ground up brand new workforce housing. So it's new construction, acquisition and development of workforce housing communities. Again, with the ability to do preferred equity investments. These pay a little differently in terms of the preferred return. So the Building Communities Fund, since again, think of ground up construction, pays an 8% quarterly return. That's paid 2% per quarter. That's your preferred return before our management split and our promote split. And the DLP Housing Fund pays 6% preferred return monthly. So think about a 0.5% dividend, which you can take or reinvest. And then in both of these, all the excess is paid at the end of the year. Once the accounting and the books are closed, you should also know that we put everything through valuation processes. The housing fund, all 62 properties get a brand new appraisal. goes through the appraisal and audit process with Cohn Resnick, our auditors, one of the top real estate real estate auditors in the country. And again, they help put that value together so it's completely verified by the third-party auditors. Good news for you if you're looking to invest with DLP is that we've been managing investment funds since 2013. We have been real estate operators for much longer than that, but since we've been managing funds, we've never had a loss to an investor ever. We've never missed a fixed return or preferred return, and we've offered consistent double-digit returns exceeding all of our target returns in every period for every fund ever. So with that, I'm going to conclude. I'm going to leave this up for a second so that you can take my information. Feel free to reach out to me. You can call me or email me at rich.delgado@dlpcapital.com, or you can scan that QR code. That'll take you to a landing page where you can put your information in and we will get in touch with you. And if you want to get in touch with someone else at DLP on my team, we have a great team that you can set up a one-on-one meeting with. So you just have to scan this QR code and you're welcome to set up time and meet with any of our investor success managers who can help you out at any time. So I hope this was informative for you. I know it was a lot in a very short period of time, but happy to spend as much time as you need to make sure you understand it fully. And again, we welcome you to give us a call and hope you have a beautiful and blessed rest of your day. Cheers.